Here's what most people don't want to hear. 90% of professional money managers can't beat the market. 90%. Which means if you're paying someone to actively trade your money, you're statistically losing. But here's the kicker. There's a completely boring, unsexy way to build serious wealth that almost nobody talks about. It's called buy and hold ETF investing. And today we're breaking down the exact 3 ETFs that have made ordinary people into millionaires without them lifting a finger. Let me be real with you. When you scroll social media, everyone's talking about the next crypto moonshot or the hot stock they heard about from their barber. But wealth isn't built on tips. It's built on time and compounding. And the easiest way to tap into compounding is through ETFs, which are basically pre-built portfolios of hundreds of stocks bundled into one ticker you can buy in 30 seconds. So why do ETFs beat individual stocks? Simple. When you own an ETF, you're not betting on one company. You're betting on the entire market. If Amazon tanks but Apple soars, you win either way because you own both. It's called diversification, and it's the closest thing to a financial cheat code. Let's talk about the big 3 ETFs that literally everyone should own. First up, SPY, the S&P 500 ETF. This thing tracks the 500 largest US companies. We're talking Apple, Microsoft, Tesla, Nvidia, all of them. SPY has returned an average of 10.7% per year since 1993. That's not a guarantee, but it's the historical average. Now here's where it gets wild. If you invested $500 a month into SPY starting when you were 25, by the time you hit 55, you'd have over $1 million. And you'd have done literally nothing but set up an automatic deposit. No day trading, no research, no stress. Second, VTI, Total US Stock Market. This is basically SPY on steroids, because instead of just 500 companies, you own 3,500 US companies. Small caps, mid caps, large caps. You're betting on literally the entire American economy. The expense ratio is 0.3% per year, which is basically free compared to paying an active manager 1% or more. Here's the pattern interrupt moment. Most people think they need to own stocks in Canada or Japan or emerging markets to be truly diversified. Wrong. If you own American tech stocks, you already own exposure to global markets because those companies sell worldwide. Apple makes phones in China. Microsoft sells cloud services in 190 countries. You're more global than you think. Third, BND or AGG, Total Bond Market. Now I know bonds sound boring as hell, but here's why they matter. When stocks crash, bonds usually go up. It's inverse correlation, which is fancy, speak for they move in opposite directions. So, if your portfolio is 80% stocks and 20% bonds, when the market tanks 30%, your portfolio only tanks 24%. You sleep better. And sleeping better means you're more likely to actually hold long-term instead of panic selling at the bottom. Let me break down what a simple, forever portfolio looks like. 40% VTI, 30% SPY. You ask why both? Overlap is fine. They move together, which is the point. 20% EGG for stability. 10% international exposure if you want it. VEA covers developed markets. That's it. 5 holdings. You set it and forget it. Now the second pattern interrupt. You don't need to rebalance annually like old-school finance people say. Just buy and hold. Your winners will naturally grow larger. Your bonds won't need touching. When you get more money, just add to your biggest position. Done. Let's talk about the actual numbers, because numbers don't lie. If you're 30 years old right now, you have 35 years until retirement. 335 months. If you invest $500 monthly into a simple 18-20 stock bond ETF portfolio, here's what happens. Month 1, $500 in. Month 12, $6,000 in. But here's the magic. You're also earning returns on top of that. Year 5, you've put in $30,000, but your account is worth about $36,000 because of gains. Year 10, you've put in $60,000, but you're sitting on about $94,000. The compounding is starting to work. Year 20, you've put in $120,000, but your portfolio is worth $360,000. Year 30, you've put in $180,000, but you're sitting on over $1 million. Let that sink in. You contributed $180,000. The market gave you the other $820,000. That's the power of time and compounding. Here's your action plan. First, open a brokerage account. Fidelity, Vanguard, Charles Schwab, doesn't matter. Set up automatic monthly deposits, whatever you can afford. $500 is ideal, but even $100 works. Second, buy your 3 core holdings, VTI, SPY, and AGG. Split it 40-30-20, or whatever makes sense for your risk tolerance. Young and aggressive? Maybe 90-10. Close to retirement? Maybe 60-40. Third, set a calendar reminder to review it once a year. That's it. Once a year. Most people who fail at investing do so because they check their portfolio too often and panic sell. You're not a day trader. You're a wealth builder. The biggest mistake I see? People waiting for the perfect time to invest. There's no perfect time. The best time was yesterday. The second best time is today. Markets go up and down, but historically, they go up way more than they go down. And when you're buying every single month through automatic deposits, you're buying at the tops and the bottoms, which actually works in your favor on average. Here's what separates millionaires from everyone else. Boring decisions, repeated for decades. Not intelligence, not luck, not secret strategies, just regular people who bought ETFs, forgot about them, and let compounding do the work. You could literally be one of those people. All you need is a brokerage account and discipline. So here's what I want you to do. First, like this video if the math hit you the way it hit me. Second, subscribe because we're breaking down more wealth-building stuff every single week. Third, drop a comment. What's your biggest question about ETF investing? Are you worried about fees? Scared of market crashes? Want to know about tax-advantaged accounts like 401ks? Tell me in the comments and I'll make a video answering it. Remember, this is not financial advice. Always consult a licensed financial advisor before making investment decisions. But also remember this, the best investment decision you'll ever make is to start. Stop researching. Stop waiting. Start investing. Your future self will thank you.